Question 9. How does TMF ETF's leverage magnify tracking errors relative to the underlying index? TMF, the Direxin Daily 20+ Year Treasury Bull 3x Shares ETF, uses leverage to achieve its target of 3x the daily return of the underlying ICE U.S. Treasury 20+ Year Bond Index. This leverage, however, magnifies not only the desired returns, but also potential tracking errors, the deviations between TMF's daily performance and the 3x multiple of the index return. Here's a detailed explanation of how leverage amplifies tracking errors in TMF. Sources of tracking errors in TMF. Fees and expenses. TMF incurs fees, like management fees, and operating expenses. These expenses eat into the ETF's returns, causing them to deviate slightly from the perfect 3x multiple of the underlying index, especially over longer periods. Rebalancing imperfections. TMF rebalances daily to maintain its 3x leverage ratio. However, this rebalancing might not be perfect due to factors like timing. Ideally, rebalancing should happen throughout the day to capture all price movements. But in reality, it often occurs at a specific time, usually before the market opens, missing intraday fluctuations. Transaction costs. Buying and selling securities to rebalance involve transaction costs. These costs can slightly reduce TMF's returns compared to the targeted 3x leverage. Impact of leverage on tracking errors. Magnification effect. While the above factors cause tracking errors in any ETF, leverage in TMF amplifies them. Even small deviations from the target 3x return due to fees, expenses, or imperfect rebalancing are magnified by the leverage factor. Example: imagine the underlying index goes up by 1% in a day. Ideally, TMF should deliver a 3% return. However, due to expense ratios and rebalancing imperfections, TMF might only achieve a return of 2.9%. This 0.1% tracking error might seem small, but it gets magnified because of the leverage. A 0.1% error on a 1% index movement translates to a 3% error, 0.1% x 3, on TMF's targeted 3% return. Additional considerations. Compounding effect. Tracking errors can compound over time, leading to a more significant difference between TMF's actual returns and the 3x multiple of the index return, especially over extended holding periods. Volatility and tracking errors. Periods of high volatility in the bond market can exacerbate tracking errors in TMF due to the challenges of precise rebalancing in a rapidly changing environment. Mitigating tracking errors. Limited options. Investors cannot entirely eliminate tracking errors in TMF. Understanding the impact. Being aware of how leverage magnifies tracking errors is crucial for realistic return expectations from TMF. Cost comparison. Comparing expense ratios of different leveraged Treasury ETFs can help choose one with potentially lower tracking error due to management fees. TMF's leverage, while aiming to magnify returns, also amplifies tracking errors. These errors arise from fees, rebalancing imperfections, and compounding effects. Investors in TMF should consider these factors and understand that the actual returns may deviate from the targeted 3x multiple of the underlying index. Question 10. What are the counterparty risks associated with TMF ETF's use of derivatives? TMF, the Direxin Daily 20+ Year Treasury Bull 3x Shares ETF, utilizes derivatives, specifically futures contracts, to achieve its leverage objective of 3x the daily return of the underlying index. While derivatives offer a way to magnify returns, they also introduce counterparty risk. Here's a breakdown of this risk in the context of TMF. Understanding counterparty risk. Counterparty risk refers to the potential for a financial loss if the other party in a financial contract fails to meet its obligations. In the case of TMF's use of futures contracts. Counterparty. The counterparty to TMF's futures contracts could be a large investment bank, another financial institution, or a government entity. Risk of default. If the counterparty defaults on its obligations under the futures contract, TMF could face financial losses. This could happen if the counterparty is unable to deliver the underlying asset, treasury bonds in this case, or make required payments. How counterparty risk applies to TMF. TMF enters numerous futures contracts. To maintain its 3x leverage, TMF continuously enters into and rolls over futures contracts. This exposes the ETF to counterparty risk from multiple institutions throughout its operations. Limited control over counterparties. TMF cannot necessarily choose its counterparties for futures contracts. They are often determined by factors like market liquidity and pricing. Mitigating counterparty risk in TMF. ETF issuers risk management. Direxon, the issuer of TMF, likely has risk management practices in place to mitigate counterparty risk. This might involve creditworthiness assessment, selecting counterparties with strong credit ratings to minimize the default risk. Diversification, spreading the counterparty risk across multiple institutions to avoid over-reliance on any single entity. Collateral requirements, requiring collateral from counterparties to act as a buffer in case of default. Transparency limitations, investors might not have full visibility into the specific counterparties TMF interacts with or the details of its risk management practices. Investor considerations. Counterparty risk is inherent. Using derivatives like futures contracts inherently involves counterparty risk. This risk cannot be entirely eliminated. Understanding the risk profile. Investors in TMF should be aware of counterparty risk as part of the ETF's overall risk profile. Limited mitigation options. For individual investors, there are limited options to directly mitigate counterparty risk in TMF. However, choosing an ETF issuer with a strong reputation for risk management can offer some level of comfort. Counterparty risk is a potential downside associated with TMF's use of derivatives. While ETF issuers like Direxon likely employ measures to mitigate this risk, investors should be aware of it and factor it into their decision-making process. Question 11. How would a liquidity crisis in the Treasury market impact TMF ETF? A liquidity crisis in the Treasury market could have significant negative consequences for TMF, the Direxon Daily 20+ Year Treasury Bull 3X Shares ETF. Here's a breakdown of the potential impacts. Impact on TMF's holdings, long-term Treasury bonds. Difficulty buying and selling. A liquidity crisis implies a drastic reduction in trading activity within the Treasury market. This can make it challenging for TMF to buy and sell the long-term Treasury bonds it holds to maintain its leverage and meet redemptions. Price disruptions. In a stressed market, normal price discovery mechanisms might break down. This could lead to sudden and significant price swings in Treasury bonds, making it difficult for TMF to accurately value its holdings. Impact on TMF's leverage and performance. Challenges in rebalancing. TMF relies on daily rebalancing to maintain its 3x leverage ratio. During a liquidity crisis, rebalancing could become difficult due to the aforementioned issues with buying and selling Treasury bonds. This could force TMF to deviate from its target leverage, potentially impacting its ability to deliver the desired 3x daily return. Amplified losses. If Treasury bond prices declined sharply due to the crisis, the impact on TMF would be magnified because of its leverage. A small decline in the index could translate into a much larger loss for TMF investors. Potential for trading halts. In extreme circumstances, the entire Treasury market could experience trading halts to prevent further panic and stabilize prices. This would completely halt TMF's ability to buy or sell holdings, potentially forcing tracking errors and hindering its ability to meet daily return objectives. Additional considerations. Increased volatility. A liquidity crisis would likely lead to heightened volatility in the Treasury market, potentially exacerbating volatility decay for TMF, discussed previously. Counterparty risk. The counterparties to TMF's futures contracts might become more risk-averse during a crisis, potentially demanding higher margins or refusing to transact altogether. This could further complicate TMF's operations. Overall, a liquidity crisis in the Treasury market poses a significant threat to TMF's ability to function effectively. Investors in TMF should be aware of this risk and understand the potential consequences for the ETF's performance and liquidity. Here are some additional points to consider. The severity of the impact would depend on the nature and duration of the liquidity crisis. The U.S. Treasury Department and the Federal Reserve would likely take steps to intervene and stabilize the market during a crisis. TMF, as a leveraged ETF, is inherently riskier than a non-leveraged Treasury ETF, and a liquidity crisis would magnify those risks. It's important for investors to carefully weigh the potential benefits and risks of TMF before investing, especially considering the possibility of a liquidity crisis in the Treasury market. Question 12. How does TMF ETF's risk profile compare to other leveraged ETFs? TMF, the Direxin Daily 20+ Year Treasury Bull 3X Shares ETF, carries a risk profile that's generally higher compared to other leveraged ETFs due to a combination of factors. Here's a breakdown of how TMF's risks stack up. TMF specific risks. Leverage amplification. TMF uses 3x leverage, which magnifies not only gains, but also losses in the underlying Treasury bond index. This can lead to significant volatility in its share price. Contango risk. TMF's reliance on futures contracts exposes it to contango, negative roll yield, where expiring futures contracts are more expensive than those expiring later. This can erode TMF's returns over time. Volatility decay. Due to daily targeting and compounding effects, even small fluctuations in the bond market can lead to a decline in TMF's performance compared to a perfect 3x multiple of the index, especially over long holding periods. Liquidity considerations. While generally liquid, TMF might be less liquid than some non-leveraged Treasury ETFs due to its complex structure. Counterparty risk. The use of derivatives like futures contracts introduces counterparty risk, meaning potential losses if the counterparty defaults on its obligations. Comparison with other leveraged ETFs. Leverage ratio. ETFs with lower leverage ratios, e.g., 2x, will generally have a less amplified risk profile compared to TMF's 3x leverage. Underlying asset. Leveraged ETFs targeting more volatile assets, e.g., high-growth stocks, will inherently carry higher risks than TMF's focus on long-term treasuries. Structure. Leveraged ETFs using option-based strategies might have different risk profiles compared to TMF's futures-based approach. Option-based strategies can be more complex and potentially less transparent. Expense ratios. Higher expense ratios can eat into returns and exacerbate TMF's tracking errors. Comparing expense ratios of different leveraged ETFs can be helpful. Overall, TMF's risk profile leans towards the higher end of the spectrum compared to other leveraged ETFs due to its combination of 3x leverage, exposure to contango and volatility decay, and the use of derivatives. Question 13. Does TMF ETF hold any securities other than Treasury bonds to achieve its leverage? No. TMF, the Direxin Daily 20+ Year Treasury Bull 3x Shares ETF, primarily does not hold any securities other than treasury bonds to achieve its leverage. Here's why. Investment objective. TMF's objective is to deliver 3x the daily return of the ICE U.S. Treasury 20+ year bond index. This inherently ties its holdings to long-term treasury bonds. Leveraging strategy. TMF uses a strategy with futures contracts and potentially swap agreements to achieve its leverage. These derivatives provide synthetic exposure to the underlying treasury bond index, eliminating the need for holding additional securities. Here's a breakdown of how TMF achieves leverage without holding additional securities. Futures contracts. TMF primarily uses futures contracts on the underlying treasury bond index. These contracts represent an agreement to buy or sell treasury bonds at a specific price on a predetermined future date. By entering into a series of futures contracts with varying maturities, TMF can magnify its exposure to the index's movements. Potential use of swaps. In some cases, TMF might utilize swap agreements with counterparties to achieve its leverage target. These swaps can essentially replicate the returns of the underlying index without directly holding the bonds themselves. Why not other securities? While TMF achieves leverage through derivatives focused on treasuries, it doesn't typically hold other securities like stocks, commodities, or even short-term treasuries for the following reasons. Focus on long-term treasuries. TMF's objective is to magnify returns specifically in the long-term treasury market. Introducing other asset classes would deviate from this core focus. Complexity management. Leveraged ETFs, like TMF, are already complex due to the use of derivatives. Adding additional security types would further increase this complexity, potentially making it harder for investors to understand the ETF's risks and returns. Efficiency. Using derivatives like futures contracts allows TMF to achieve its leverage efficiently without the need for physically holding and managing a basket of underlying treasury bonds. Transparency note. The exact details of how TMF achieves its leverage, including the specific mix of futures contracts and potential swap agreements, might not be entirely transparent to investors. The ETF prospectus would provide a general overview, but the daily rebalancing process can involve complex financial instruments. Overall, TMF primarily relies on derivatives focused on long-term treasuries to achieve its 3x leverage, avoiding the need for holding additional securities that would deviate from its core investment objective. Question 14. Are there unleveraged long-term treasury bond ETFs that achieve similar exposure without the risks of TMF ETF? Yes, there are several unleveraged long-term treasury bond ETFs that offer similar exposure to the long-term treasury market without the risks associated with TMF, the Direxon Daily 20+ Year Treasury Bull 3X Shares ETF. Here's a breakdown of the key points. TMF's risks. Leverage amplification. TMF magnifies both gains and losses in the underlying index due to its 3x leverage. This can lead to significant volatility in its share price. Contango risk. TMF's reliance on futures contracts exposes it to contango, where expiring contracts are more expensive than those expiring later. This can erode returns over time. Volatility decay. Daily targeting and compounding effects in TMF can lead to a decline in performance compared to a perfect 3x multiple of the index, especially over long periods. Other risks. TMF also carries liquidity considerations, counterparty risk, from using derivatives, and potentially higher expense ratios compared to some unleveraged alternatives. Unleveraged long-term treasury bond ETFs. Investment objective. These ETFs aim to track the performance of long-term treasury bond indexes without any leverage. They offer a more direct and proportional exposure to the long-term treasury market. Lower risk profile. since they don't magnify movements. Unleveraged ETFs experience lower volatility and are generally considered less risky than TMF. Examples: here are some popular unleveraged long-term treasury bond ETFs. SPDR, Portfolio Long-Term Treasury ETF, SPTL. Vanguard Extended Duration Treasury ETF, EDV. Schwab Long-Term U.S. Treasury ETF, SCHQ. iShares 20+ Year Treasury Bond ETF, TLT. Choosing between TMF and unleveraged ETFs. Investment goals: consider your goals. If you seek potential for magnified returns and are comfortable with higher risks, TMF might be an option for a suitable risk tolerance. However, if you prioritize capital preservation and a more predictable investment in long-term treasuries, unleveraged ETFs are a better choice. Risk tolerance: honestly assess your risk tolerance. TMF's volatility and potential for significant losses can be unsuitable for risk-averse investors. Investment horizon: unleveraged ETFs are more suitable for long-term investment horizons as they track the long-term treasury market's overall growth without the day-to-day volatility of TMF. Benefits of unleveraged ETFs: lower costs: unleveraged ETFs typically have lower expense ratios compared to TMF, which can improve long-term returns. Transparency: their holdings and performance are generally easier to understand since they directly track the underlying index. Liquidity: unleveraged treasury bond ETFs are typically more liquid than TMF, making it easier to enter and exit positions. Remember, unleveraged ETFs also have their own risks, such as interest rate risk, bond prices fall as interest rates rise, and inflation risk, purchasing power of bonds erodes over time. However, these risks are generally considered less severe compared to the amplified risks associated with TMF. Question 15. Are there inverse leveraged treasury ETFs that could be used to hedge against potential interest rate rises? There are inverse leveraged treasury ETFs that can be used to hedge against potential interest rate rises. Here's how they work and some things to consider. Inverse leveraged treasury ETFs. Investment objective: these ETFs aim to deliver a return that is inversely proportional to the performance of an underlying treasury bond index. In simpler terms, they profit when the value of the index declines. Hedging with rising rates: since bond prices generally fall when interest rates rise, inverse leveraged treasury ETFs can be used as a hedge against rising interest rates. If interest rates go up and bond prices go down, the inverse leveraged ETF would experience a gain, potentially offsetting losses in other parts of your portfolio that are interest rate sensitive, like long-term bonds. Examples of inverse leveraged treasury ETFs. ProShares Short 20+ Year Treasury ETF, TBF. Direxin Daily 20+ Year Treasury Bear 3x Shares, TMV, but with opposite returns to TMF. ProShares Ultra Short 20+ Year Treasury, EFV. This one uses a 2x inverse daily return strategy. Important considerations. Leverage amplification: remember, these ETFs are leveraged, meaning they magnify both gains and losses in the underlying index. While they can amplify gains when bond prices fall, they can also magnify losses if bond prices rise unexpectedly. Contango risk: similar to TMF, these ETFs might be susceptible to contango, negative roll yield, in futures contracts, potentially eroding their returns over time. Volatility decay: daily targeting and compounding effects can still lead to some volatility decay, meaning the ETF's returns might not perfectly reflect the inverse of the underlying index, especially over long holding periods. Hedging effectiveness: hedging with inverse leveraged treasury ETFs is not a perfect science. The effectiveness depends on the precise movements of interest rates and bond prices. Alternative hedging strategies. Shorting Treasury bonds. Advanced. For experienced investors, directly shorting Treasury bonds can be a more precise hedging strategy, but it also carries significant risks and requires a margin account. Interest rate derivatives. Advanced. Using interest rate futures or swaps can be another hedging strategy, but these instruments are complex and require a high level of financial knowledge. Overall, inverse leveraged Treasury ETFs can be a tool to hedge against rising interest rates, but they come with their own set of risks. Question 16. What other asset classes could provide similar diversification benefits to TMF ETF? TMF, the Direxin Daily 20+ Year Treasury Bull 3x Shares ETF, carries a unique risk profile due to its 3x leverage and focus on long-term treasuries. While it offers potential for magnified returns, it also comes with amplified risks like volatility decay and contango. Here's a look at some asset classes that can provide diversification benefits to TMF and offer a more balanced risk-reward profile. Asset classes for diversification. 1. Equities, stocks. Benefits. Stocks offer the potential for capital appreciation over the long term and can outperform treasuries during economic expansions. Risks. Stocks are generally more volatile than bonds, and their prices can be impacted by various factors like company performance and overall market sentiment. 2. Commodities. Benefits. Commodities can act as a hedge against inflation since their prices often rise with inflation. They can also provide diversification from traditional stock and bond markets. Risks. Commodity prices can be highly volatile and impacted by factors like supply chain disruptions, weather patterns, and global economic conditions. 3. Real estate investment trusts, REITs. Benefits. REITs offer exposure to the real estate market and can provide income through regular dividend payouts. They can also exhibit lower volatility than stocks. Risks. REITs are still subject to real estate market fluctuations and can be impacted by interest rate changes. 4. Alternative investments, e.g., hedge funds, private equity. Benefits. Alternative investments can offer diversification from traditional asset classes and potentially provide uncorrelated returns. They can also target specific investment strategies not readily available through other options. Risks. Alternative investments often come with higher minimum investment requirements, higher fees, and lower liquidity compared to stocks and bonds. They can also be complex and require a strong understanding of the specific investment strategy. Choosing the right asset class. The optimal asset class for diversification depends on your individual investment goals, risk tolerance, and investment horizon. Here are some factors to consider. Risk tolerance. If you are risk-averse, consider asset classes with lower volatility, like investment-grade bonds or dividend-paying stocks. Investment horizon. For long-term goals, asset classes with higher growth potential, like equities or commodities, might be suitable. Overall portfolio allocation. The specific asset classes you choose should complement your existing holdings and create a well-diversified portfolio. Benefits of diversification. Reduces overall risk. By spreading your investments across different asset classes, you can mitigate the impact of negative performance in any single asset class. Provides balance. Diversification allows you to balance the potential for growth with income generation and capital preservation. Smooths out returns. Combining asset classes with varying risk-return profiles can help create a smoother overall portfolio return experience. Remember, there is no single best asset class for diversification. The key is to understand the risk-reward characteristics of each option and choose those that complement your overall investment strategy. Alright everyone, that brings us to the end of our deep dive into the TMF ETF. So, what's the verdict? The TMF ETF can be a powerful tool, but it's definitely not for everyone. For investors with a high risk tolerance and a specific investment goal, it could be a way to potentially magnify returns in the long-term treasury market. But remember that magnification goes both ways, losses can be tripled too. We explored alternative strategies like actively managed bond funds, bond ladders, and even high-yield bond funds. Each offers different risk-reward profiles, so there's likely an option out there that aligns better with your comfort level. No matter which path you choose, make sure you understand the risks involved before investing. Do your research, consider your goals, and maybe even chat with a financial advisor. And hey, if leveraged ETFs aren't your thing, don't worry. There's a whole world of ETFs out there waiting to be explored. We'll be uncovering more of them right here on Chat ETF, so hit that subscribe button and stick around. Thanks for joining the conversation, and happy investing.